Hello and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Markets are trading mostly higher today. We are seeing between 1 and 2% gains in European equity markets. I think the most important thing here is we've finally broken above the trading range which we were stuck within for most of this month, but primarily the last 3 weeks. We've finally broken through there. We saw it pressing the highs of the range yesterday, and it seems potentially this Greek deal that's been agreed, in principle at least, between Greece and its creditors, and includes the IMF, appears to have given it that extra leg higher and taken it through what was previously a zone of resistance, potentially leading the way to further gains to come in the coming weeks. But we'll have to wait and see whether that momentum can be sustained. But the early signs are relatively positive. Like I said, I think the Greek deal is potentially helping to support this drive through that resistance so far today. It's been a big step forward really for Greece and its creditors. It's been described by Eurogroup President Jerome Dijsselbloem as a breakthrough here, because not only have they agreed a deal effectively before the 11th hour, which is usually the case, but they've also agreed on a deal that involves the IMF, which means there is going to be potential debt relief measures for Greece to come. Now, I think the IMF wanted to see some form of debt relief in this agreement, but it just wasn't feasible at this moment in time, simply because over the next year or so we've got elections to come in Germany, in France, in Italy, and Spain, and any form of debt relief prior to these elections was probably not going to sit well, both with the electorate but also with the MPs who would have to vote it through Parliament as well, because obviously they have the personal seats to think about as well. So it was potentially unlikely, but what they've agreed to is to readdress the debt relief measures in 2018, once the current Greek deal has once the current bailout has been completed. Now, what this deal currently does is it allows for 10.3 billion euros to be released to Greece. The first instalment is going to be 7.5 billion euros, which will allow them to meet their debt repayments in July, which is primarily going to be to the ECB and the IMF, and then the rest of it's going to be released over the next few months, pending Greece completing the measures which were agreed in order to get this bailout. This includes things like tax hikes such as VAT. It includes reforms. It includes the formation of a privatisation fund, among other things. So very unpopular measures to an extent in Greece, but things that have been passed through Parliament thanks to the slim majority that the Syriza party does currently hold. And like I say, it does open the door then to this debt relief come 2018. Now, how this debt relief is going to be structured, I think, is going to be relatively complex. I think the idea of debt forgiveness is effectively off the table. Staunch opposition to that, particularly in Germany, but also in other Eurozone states as well. Debt relief, on the other hand, can be structured in such a way that I think it may almost deceive, or it just goes over the head. It'll go over the heads of a lot of people. So rather than saying, well, you don't have to repay this back, they can instead say, well, we're going to extend the maturities on this. We're going to roll over this debt with a lower interest rate, maybe take the higher interest rate debt that the IMF currently owns and replace it with money from debt from the ESM fund, which comes with much lower rates of interest, which ultimately at the end of the day reduces the burden on Greece further down the road, and therefore is a form of debt relief. There's also going to be likely to be agreements in there on the profits which the ECB generates from its loans to Greece will then be given back to the Greek government, pending the implementation of certain reforms and tax cuts, which again will be used to reduce its overall debt. So there's going to be a number of measures which will be put in place, but I think what they're aiming for here is a way in which they can do this that won't be clear that they are offering relief to Greece, which of course would be very unpopular. But it also means that Alexis Tsipras and his Syriza party can go back to the Greek people with some form of win, claiming that they have achieved debt relief, something no previous parliament was something that that seemed very unlikely, and that there was strong opposition to with its creditors. But ultimately, I think there is going to be a continued period of stagnation at very best for Greece, because things like the tax hike the VAT hike, which was passed through Parliament recently, is going to put more strain on the Greek economy. But this is being seen as a step forward, and the fact that it's not come down to a last minute, we haven't seen these battles which have led to Greek yields going to unsustainable levels and led to talks of Brexit again, I think has been seen as a positive here. Now we've seen Greek yields at 1 point today on 10-year debt falling below 7% since the first time since November. So that says a lot about how the markets are viewing this solution. And again, like I say, European equity markets trading higher off the back of this. Another story that we've got today is again focused around the Fed. Now the implied probability of the Fed raising rates at June has now risen to 38%. Again, this just comes off the back of the continued hawkish commentary that we are getting from different Fed officials. The latest was James Bullard, who's been a bit more balanced in his approach to this compared to certain other officials, but he has stated that June, July is very much on the table, and that the unemployment, current level of unemployment at the US does actually, in his view, come to full employment or even beyond full employment, which in his view again is the most important measure. But of course there is other data which they have to consider before they hike interest rates in June. But he did also state that just because July doesn't come with a press conference following, they don't have to necessarily therefore act in June. They have raised rates previously without the need for a press conference after, which potentially suggested, in his view, he would prefer maybe to wait until July for a rate hike, because I imagine that's got a lot to do with the Brexit referendum, the EU referendum in the UK, which comes just over a week after that Fed meeting in June. But it is all sounding very hawkish. It is all sounding like this summer is a go for the next rate hike, which would potentially leave leave room for another one towards the end of the year. Now today we are going to hear some more Fed speakers, so we'll be looking more for these hawkish tones. We've got Neil Kashkari speaking, Patrick Harker and Robert Kaplan all speaking. It's worth noting that none of these are voting members on the FOMC, but if we continue to hear this hawkish rhetoric, then that would again suggest that the balance power has moved in favour of the hawks on the FOMC, and would suggest that we are seeing a concerted effort from different officials to drill into the markets that a summer rate hike is on the horizon. Now if we take a look at what else we've got to come today, it is looking like a relatively quiet session. We've had some positive data from Germany so far today. The notable point here, I guess, is the expectations from the IFO, because this isn't really in line with what we had over the last couple of days, which suggested that the outlook for the German economy, as far as people are concerned, was looking pretty bleak in the short to medium term. This suggests actually people are far more optimistic, which I think was interesting this morning. But like I say, still to come today, we do have a couple of pieces of data. We've got market services and composite PMI, EIA crude oil inventories, which I think is important. We are seeing oil trading around 1 to 1.5% higher today, which again is helping to lift these equity markets. And I think this is driven by the API number which we had yesterday, showing a 5.1 million drawdown in crude inventories, again suggesting that the output the issues in Nigeria and Canada, etc., is having an impact now on overall production, the supply-demand scale, and therefore this is helping to support prices towards that $50 a barrel level. We'll be looking for this EIA number today to confirm what we had from API yesterday, which may be enough to actually propel Brent crude and WTI through the $50 level. We've also got the Bank of Canada interest rate decision and rate statement also to come today. So still a couple of key things to keep an eye out for today, but I think the overriding story is going to continue to focus around Greece and the Federal Reserve. For more news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.